Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Jeff Shilling. Jeff is a principal with Pacific Cost Segregation, a company I've used many times. In addition to cost segregation projects, he also provides supervisory and technical expertise to allocation of purchase price, tangible property regulation, and energy studies. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz, and we'll start the conversation.
Thanks for joining us, Jeff. Can you start by telling the listeners a little bit more about yourself?
Absolutely. Thank you for having me, Gary. I am a 35-year plus tax depreciation tangible asset professional, commonly referred to by my colleagues as the tangible asset guy. They've developed an in-depth knowledge of the tax laws and regulations and court cases that govern the treatment of fixed assets. And currently, in my current role, I help clients maximize the amount that they can take as depreciation deductions. Also, as you mentioned, assist with energy studies and allocation of purchase price studies, again, for tax purposes, whether it be federal or state, and helping clients to get the maximum benefits that are legally obtainable related to tax write-offs.
I think a lot of our listeners know what bonus depreciation is, but don't know the mechanics behind it. And maybe you can explain what a cost segregation company does.
Sure. So what we do is we're analyzing transactions on behalf of taxpayers. When I say transactions, that's either new construction or what's more typical, acquisitions, because the taxpayer gets an opportunity to reset depreciation upon each new transaction that they're involved in. So you purchase a property, you start depreciation over again. So what the cost segregation professional is doing is via cost approach, which is the valuation theory that undermines what we do, we reallocate the purchase price to the various components or portions of the asset that's been purchased. So simplest example, if you're talking about an apartment building, the first step, and we rely on our clients to provide us the information to do this, but the first step is to allocate between land and building. Then you have that chunk of the purchase price that represents the building. We reallocate that to the individual assets that were purchased. And the reason for doing that is that the building itself has to be depreciated over, in the case of multifamily held for investment, 27 and a half years. However, there are many components within that building that can be depreciated over a much shorter period of time. Things like carpeting, window coverings, appliances, items that are exterior to the building that can be depreciated over a 15-year life. such as land improvements. And as you mentioned, the import of that is since 2018, anything that gets into a depreciable life of 20 years or less qualifies for bonus depreciation, which currently is 80% of basis. But for the last 5-6 years, it has been 100%. And it's dropping down 20% each year. And we'll have to see what happens with the next administration, whoever that may be, whether they reboot bonus or let it continue to decline. So
I know, and the House passed that tax relief for American Families and Workers Act of 2024, which included, among things, bonus depreciation going back to 100% retroactive to 2023. And the Senate's kind of like sat on it. And what I'm hearing is, maybe till after the election. I'm not sure if you're hearing anything different.
Roughly the same thing, that the ball has been started rolling. Whether or not it gets held up or kicked back, we'll see. There's always, as you know, and as your investors know, there's always competing agendas for what gets included and what doesn't.
Yeah. I mean, as a real estate investor, and I know people have taken advantage of it in oil and gas and in other areas as well, but bonus depreciation has been fantastic when investors can invest, $100,000, $1 million into a deal and getting, 80, 70, even 60% write-off. Not everyone can take advantage of it. They can use it against capital gains, passive income, or carry it forward until the sale. And there's some recapture, usually not more than 25%, but it's a great way to really kind of hyper speed your investment portfolio, because then you're not paying taxes on this money. You're able to reinvest this money, which is a beautiful thing.
Absolutely. I love to hear when I talk to taxpayers and the uninitiated in cost segregation and or bonus depreciation, often will say, well, yes, but it's strictly a timing difference, right? And I say, well, yes, it is a timing difference. We're going to be able to write off and take full advantage of 100% of the depreciation in this tax year or today that would have otherwise been spread over 5, 7, which that's not a huge difference, but it's still, cash is king, obviously. But when you're talking about being able to take 100% bonus on a 15-year asset that drops off less rapidly, and you can take advantage of that in day one, when you combine your federal tax rate and your state tax rate, that's money that you're hanging on to that you could reinvest in the property today rather than waiting 15 years and having a much smaller incremental amount that you can actually do something with.
Absolutely. So there's a bunch of cost segregation companies out there. So what should someone look out for when they want to hire someone that is reputable and really good at what they do? What are there certifications? What should they be looking for?
Well, there are certifications. There is an organization that I and my partners are involved in called the American Society of Cost Segregation Professionals. It was started, and I and some others in the industry saw a need to create an organization that we hope is still even at 15 years old, it's somewhat fledgling, but we hope will grow into, the bar started somewhere. CPAs started somewhere with a desire to create an organization that is all about qualifications and education for professionals, yes, but also an organization that the public can look to and say, okay, so these are people that have tested, that carry a certification, They've got minimum 5 years of experience, and they've agreed at least to adhere to a set of codes of conduct that support the public in obtaining, if you will, the tax benefits or making sure that they are correctly depreciating assets. At the end of the day, someone looking for a cost segregation provider may get different estimates of benefit up front. First of all, a quality provider is going to provide that for you at no cost to give you an idea of, based upon their experience, what they think they'll end up with classification-wise. If you get wildly disparate estimates of benefit, understand that nobody can find you more depreciation or reclassify your property drastically. We're all going to get to roughly the same results if we're assuming credible providers. Somebody's promising you the moon, you probably want to check and get a couple of more estimates because, and or ask them what their audit experience is. Because audits don't happen a lot, but when they do, maintaining the deductions that you've already taken, especially given that audit happens 2 or 3 years down the road, is very important. So you want somebody that is, experienced, has got a track record, is associated with I highly recommend finding a provider that's associated with the ASCSP, that has a CCSP certification. And, word of mouth is still amongst the best, whether it be referrals and or, confirmations that you're dealing with somebody. And then the other thing to look for is, how are they going to support you after the fact? Are you dealing with a provider that is going to help you respond to, the initial IRS inquiry, should it come, associated with whether it be a desktop audit or an audit of the tax year that includes the cost segregation? So make sure you understand what the support's going to be after the fact as well. And then it's a firm that you expect to have that will still be around 3 to 5 years down the road to provide that support if necessary.
Yeah, that's super helpful because, like I said, there are a lot of companies and a typical operator, someone that owns some of these properties doesn't necessarily. There hasn't been much education and talk about what separates one from the other, and so knowing those things is really important. People have asked me in the past, and when we did our research a couple of years ago, we felt we had switched companies to yours. We just felt that for all the reasons you said, it was just a much safer, more professionally, cost segregation company to work with. I get a lot of questions too on, when should you do a cost segregation or when wouldn't you not? Because, I've got friends that have like single family homes or duplex. Like, is there a certain unit count? Talk me through when's a really good time?
Well, the easiest time. Let me start this over. The most difficult time to perform a cost segregation is when the client doesn't have any of the original documentation associated with the deal. So taking a step back from that, we obviously can, because there's the opportunity to reallocate the property, if you will, or do this allocation upon purchase or new construction, that obviously indicates that in the year that the asset's capitalized, there's an opportunity to do a cost segregation. What many people don't realize is that you don't forego that opportunity if you don't take advantage of it in the first year. So we can do a cost segregation study anytime in the life cycle of anytime that the asset is still being depreciated. It does require an additional form. It's a request for an automatic change to the method of accounting, because depreciation is a method of accounting. And then what happens, back to your question earlier of the mechanics, the catch-up depreciation, assuming that that's, you're doing it for additional depreciation benefits. So you didn't take any in, say you held the property for 5 years. All of the depreciation that was missed, we get to catch up in the year of of that tax filing. So that can be pretty powerful, especially if, let's say you've become a real estate professional and now you can take those deductions against active income. Or if you've sold another property that may have been a passive income property and you could use the new deductions associated with cost segregation against the other passive income from the sold property. So there can be some opportunities for planning as to when to take advantage and when not to. Getting back to your question of when wouldn't you, or what are the primary drivers? Back to what I just said, it's when you can utilize the deductions. If you're a passive investor and all you're going to be doing is creating passive losses that you can't take against, or you don't have enough income to cover those additional passive losses, you're offsetting those until you sell the property. Well, now your timing difference is not doing anything for you because you're just waiting until you get to the end. You can do a cost segregation in the year that you get rid of a property as well. And that may make sense depending upon how results are measured. This is getting beyond topic, but is there a waterfall agreement associated with internal rate of return that puts more money in your pocket with greater deductions in that final year? Or if you're doing a 1031 and you want to create a greater deferral, so write more of that basis off before you do your exchange. So as I said, there are some planning opportunities involved. The only time I wouldn't do a cost seg is, as I said, if all you've got are it's a passive loss and you don't have passive gains to offset it against, or if the property value is low to the extent that when you look at how much of a deduction you're going to create and the tax savings associated with that, and probably the big one is how long do you plan on holding the property? If you're not going to hold it long enough to take advantage of that time value of money, or if the benefits just, if you're not getting a multiple of what the fee is to conduct the study, it's probably not worth doing.
Yeah, I was told years ago, like, hey, if you're not going to hold a property longer than 2 years, it's probably not worth it. And I always thought here I'm getting a massive tax savings and I can use it right away and my investors can use it right away. So even if I was going to hold the property for 2 years, maybe longer, it was still worth it. I mean, am I wrong for thinking that way or no?
Well, again, it's as we talk about time value of money. So what's a dollar today worth versus that dollar 2 years, 3 years, 4 years down the road? I would typically say if the hold time isn't at least expected at the outset to be at least 2 years, I'll have that discussion with a client. That's the other thing that's important when you're talking about a provider is making sure you're talking to somebody that can answer your questions and will talk through those scenarios with you. If you're talking to somebody that, it's a business development or sales person for a cost segregation company and all they want to do is get you signed up, maybe talk to some others as well, because what you want somebody that knows the ins and outs, understands or can put themselves in the investor's shoes to make sure that this is going to do more than just give you a pretty depreciation report, that it's actually going to provide the financial benefits that you're looking for. I will say as a counter to that, I am oftentimes, I have been surprised several times over my career where I typically work under if it's not providing at least a 4-to-1 cash benefit to the cost of the study, or net present value, depending upon how you measure the benefits. If it's not providing at least a 4-to-1, it's probably not worth doing. And then I talked to somebody that was it 1.5, 2 times to 1 to the benefits. And he said, bottom line is if it means I hang on to the money versus sending it to the IRS and getting it back over time or getting it back in a refund, I'd much rather hang on to my money than give it to the IRS. And if that provides me a 2-to-1 benefit at the same time, sounds like a win-win. So it depends on how, the investor's motivations and how strong, we've had investors that just have a strong desire for cash today because they see an investment opportunity they can take advantage of. And so they want whatever available equity is there they calculate it based upon tax savings, and have an opportunity to redeploy that they may not have next year or the year after. So that can be a motivating factor as well.
And I'll also add, like we've closed a number of deals at the end of the year, and you don't, if this past year we closed in December, and you guys did the cost seg, I think, maybe the end of February, we still use that cost seg study for 2023. So it doesn't mean just because you close at the end of the year, you've got to wait a whole year. You're able to do the study as long as it's done before our taxes. We're fine, and our investors can take advantage of it. So that's a really nice thing that people should be aware of.
Yes, we've got until the tax return ultimately is filed. So you can even have that extended out to the September and October 15th deadlines, depending upon what type of taxpayer you are as well. So there's typically plenty of time to get it done. On the other hand, as a tax consultant, we're always busiest during March and August because people often don't pull the trigger. So, to the extent that your investors can pull the trigger a little earlier, it would make my life easier to manage.
Absolutely. Is there anything I didn't ask about cost segregation that investors should know about?
No, I mean, that's essentially it. We say a tax savings, but it's really a tax deferral strategy, but for what can be significant periods of time. We talked about the look back or the ability to do it after the fact, coupled with 1031 exchanges. It can be a very powerful tool. But I guess that's the one difference we didn't talk about is when you've completed a cost segregation study on a property, and this kind of goes to your 2-year or longer hold as well. If you have the ability to write off 100% of the short life property, which I didn't really mention this, but part of what we identify that can be depreciated over a short life asset is not things that are always intuitive, like wiring buried inside the walls, some plumbing, depending upon what that plumbing serves, buried inside the walls. So these are not assets that diminish in value very quickly. When an investor sells a property, they have to reallocate the gain. Let's say it's not a 1031. They have to reallocate the gain to the various classes of property. One of those classes of property, even if it was a 1031, is going to be personal property. So if you're only holding it for 2 or 3 years, it obviously doesn't make a lot of sense that the value of those assets are truly zero. When you're talking about kitchen cabinets, maybe the appliances, maybe the carpeting, yes, but there are going to be some assets that have greater value, and it's up to the investor to allocate that value. What a cost segregation in part helps to do is because we have driven those values down very quickly. The old adage of pigs get fed, hogs get slaughtered comes in. You don't want to claim that you sold those assets for zero, but you can claim that, a reasonable person would look at them and say there's only 25%. And then anything you allocate, any delta or arbitrage that you create by allocating smaller dollars to the short-lived assets, which because there was bonus taken on it and because it was accelerated depreciation, that applies ordinary income rates apply to that gain. But anything you've transferred to the real estate, the real property, whether it be the building or even the external land improvements, that gets a capital gains rate. Or in the case of the 1031, gets deferred until ultimately you take in cash. So that arbitrage game is part of what cost seg is all about as well. Is the ability to transfer or put the investor in control when they file their taxes of how much value they claim for the short-lived assets that gets ordinary income treatment versus how much they claim for capital gains.
And, when someone does a 1031, they can do a whole cost segregation study on that new property and just keep doing it, not paying the tax bills, but yet keep getting the benefits of the cost seg studies, correct?
Yeah, the key to the involving 1031 with the cost seg is only real property can be traded through the 1031. So if you're talking about an apartment building that has, especially if you do the cost seg, has a fair amount of what we say is 1245 or personal property assets, you got to make sure that you're stepping up in value enough so that you're paying cash or taking on new debt of a quantity that covers the personal property asset. So when you're looking at doing 1031s, you always want to be in a minimum same value of property, so that you're not stepping down in value, or you are going to create taxable gain for yourself. As long as you're stepping up and covering the personal property that's going to be broken out, you could go on indefinitely, even to the extent that you let your heirs take care of the tax, ultimately.
Yep. It's a beautiful thing.
Yes, it is.
Well, Jeff, thank you for that education on cost segregation. I know it's been a great tool in our toolbox, and our investors' toolbox. Where can other listeners find out more about you and your company?
We have a website, of course, pacseg.com, PACSEG.com, and profiles of myself and my partners are there, along with contact information. And we'd love to work for your investors. Working for you already, might as well branch out further.
Absolutely. And I appreciate all that you guys have done for us the last few years, and looking forward to doing a heck of a lot more when deal flow picks up.
Yes, absolutely. Thank you for the time this morning, Gary.
Absolutely. Thank you. This is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.